Hello there. Today is Wednesday, March 25th, 2026, and welcome to the Kluge Wealth Advisory Group Client Connect video for March 2026. This video will have a bit of a different format than our usual monthly videos and should be considered a follow-up to our special edition that we published a couple weeks ago. You can find that special edition video on our website, on our YouTube channel, or on our X feeds. Now, in the course of this video, we're going to cover off a few things, including some observations and thoughts I wanted to share. We're going to touch on a few of your frequently asked questions. We're going to discuss a couple of filters that we can use to understand current events. And then finally, we're going to touch on our strategy going forward and what we can do to benefit from these volatile times. Now, before we get into the meat of the video here, there's a couple of housekeeping items I want to touch on. The first is that, due to the fact that the situation is very fluid, please take my comments in the context of looking at things in the long term, which of course matches up with all of our long-term objectives, goals. Now, the second thing I want to touch on is that despite all the volatility, I want to remind each and every one of you that we are also here to provide a comprehensive wealth solution. Just because things are happening in the world doesn't mean that concerns such as retirement income planning, will and estate planning, insurance planning, tax planning, what have you, fall to the wayside. So if there are concerns you have, or there are things you want to discuss, or challenges or areas where you need some advice, please keep them coming. We are happy to make sure that we are delivering this advice to you at all times. And again, we do have great resources here within the team, between myself, Scarlett, Jordan, and Kyle. We have access to the Wellington Altus Advanced Wealth Planning Group, as well as we have access to third-party providers. So we have a lot of great resources and they're here at your disposal. Now, let's jump right into the meat of the video here. Well, let's get into some thoughts and observations here. I will ask, everyone's forgiveness here for me looking at my notes. However, I do want to make sure that we cover off all the important points. The first thought I wanted to share was just a bit of a follow-up from our previous video. And the main thought here is that I just want to share that it continues to appear that both sides, whether it's Iran or the United States and Israel, continue to be thinking past the sale towards the peace. There has been some damage to shipping and some infrastructure. However, there have not been wide-scale attacks on power plants, desalination facilities, or oil and gas infrastructure. Now, that could change at any moment. However, at the moment, both sides appear to be thinking beyond the war and into the peace, and that is, we should all take heart from that. The second observation I want to share is that investors are very stressed out. I think some of you may relate to the photo of our friend here, the deer in the headlights, and that is completely understandable, just given the pace of headlines and the number of headlines that keep coming out. And we'll talk a bit more about the implications for how investors are feeling a little bit later in this video, but we can also share a slide here from Ned Davis Research, which has a proprietary fear gauge. And you can see, it may be a bit hard, but you can see on the lower right-hand side, that the level of fear is very, very high, and that is associated with very strong positive forward returns. So that's something to bear in mind and something we'll talk about a bit more later. The other thing we want to talk about here in regards to this is the fact is that there are a lot of narratives out there, and some of them are quite negative. And I always want to remember that each and one of these narratives is very linear, they're very logical, and they do seem to make a lot of sense. However, they do typically make some pretty big assumptions, and that one big assumption that they all make is that the current conditions persist from now until their logical or illogical conclusion. And the bottom line is we know that's not the way the world works. When we get into times like this, I always want to invoke the law of slow-moving disasters. Now, the law of slow-moving disasters says that if you can see a major disaster ahead, that almost always people will figure a way to manage around it, manage through it, get through the situation to a better conclusion than what the linear reasoning says. And that's because human beings are self-interested. Everybody at a certain level wants to make sure that good things happen and bad things are avoided. And so the law of slow-moving disasters simply latches onto that and says that if there's a giant problem ahead and it seems insurmountable, well, the overwhelming majority of the time, human beings will find a solution to that. Another thing we wanted to touch on here, because we have seen a few questions on this, so I'll just address it directly, is that we're going to put up another slide here, from our friends at Fundstrat. And this one just basically concludes and says, look, like oil price spikes don't necessarily lead to market crashes. This has been a consistent narrative and a consistent thing that I've seen in through the media. And the reality is that you can see from the data points is that that's just not the case. So just wanted to put this slide up. Here's again a bit of reassurance, and again, it always comes down to just referencing back to the level of fear that's out there, referencing back to the law of slow-moving disasters. Right, higher oil prices are a problem. However, solutions are generally found. In the broader picture, I also want to touch on a couple of other thoughts here. Right, the first is that corrections throughout the year are absolutely normal. And again, this slide we're going to show from Fidelity here shows that it's pretty normal to have 5% corrections as well as a 10% correction per year. We've just kind of gotten into that 5% correction level, so we're not even at a point where the market has started to behave abnormally or behaving in the market is continuing to behave in a very, very normal way. So I think we should again all take heart from that, despite how unsettled things may feel. The market is behaving normally. It's completely normal to have multiple 5 to 10% corrections in a year. Larger corrections, like 15%, are much less frequent at about one every 3 years. And always remembering last year we did have a 20% correction, so the probability of that event happening back to back is very, very low. And we have to remember we're in a time of intense geopolitical headlines, and geopolitics does tend to affect the market in the short term. However, in the long term, the overwhelming percentage of the time, markets are positive 12 months out, as you can see from this chart here that we have, again, from our friends at Fidelity. So we always have to remember that this volatility is temporary, and that we want to be keeping that in mind as we navigate through it step by step. Now, there's a couple of observations I do want to share here just about some market action, which I think is frankly quite positive. I think that the fact is that if you take a look under the surface, what we've seen in the last month is that sectors like technology and growth stocks have been outperforming the general market as well as value style stocks. Typically, growth stocks or technology lead on the downside. You can kind of see that they did come under some pressure here earlier in the year and late last year. That seems, on a relative basis, they are now starting to outperform, which is usually a sign in the past that markets are, that there is a potential bottom forming here. Again, no guarantees of that, just an observation. But another interesting thing is that, again, Bitcoin has outperformed gold. That is, of course, a more extreme expression of the growth stocks versus value stocks idea. But we're seeing that across multiple asset classes where assets that typically lead on the upside and lead on the downside are beginning to turn to the positive, or at least on a relative basis. So I think it's important to take heart from that, and that we always want to remember that it's not always visible on the at the big market level or in the headlines, but what's happening on the surface is very, very important. Now, if any of you have any questions on any of these observations or thoughts, happy to have a further conversation. Please pick up the phone, give us a call. We're here to help. In this section, I want to review a couple of lenses that I think are useful in promoting understanding about what is happening and why it's happening. Now, understanding in and of itself is always a good thing. And please don't take anything that we're saying here in a political context. We're just trying to provide some observation, and we'll let, of course, each and every one of you come to your own conclusions. The first lens or filter that I want to share is what I like to call the China filter. Now, anytime you're dealing with President Trump and foreign policy, we always have to remember that the primary American rival at this point in the world is China, and that Chinese relations are foremost in his mind at all times. So the China filter basically says that the reason why the Americans are attacking Iran at this point is that it's reminding the Chinese of the vulnerability they have in terms of their need to import 11 million barrels a day of oil before they go into joint US-China trade negotiations that are scheduled to start here shortly. Now, these negotiations may or may not be delayed at this point. However, we do know that President Xi and President Trump are going to be engaging on this, and that through this China filter, you could see that the Americans are reminding the Chinese about their energy vulnerability, just like the Americans have been continually reminded about their vulnerability in terms of the ability to refine rare earth metals. So interesting filter to put over things, and it certainly does hopefully provide some understanding there. The second filter I want to share is a filter that I call mutual interest. Now, it's very interesting the fact in this conflict that the US and Israel are both attacking Iran, and that you actually see a fair degree of cooperation from all of the Gulf states, right? Israeli jets have to be able to fly over many of these countries in order to get to Iran. And the Gulf states have certainly been very quiet and providing air bases and other support to this effort. So why would that be? I think it's important to understand this in the context that it is in everyone's interest, whether we're talking about Saudi Arabia, whether we're talking about Israel, or we're talking about the United States, that we defang Iran. We being, of course, those three. There's the interest of those powers to defang Iran. None of them wants Iran with an atomic weapon. You can certainly understand why the Israelis don't, given Iran's history of threats to obliterate them. The Saudis certainly don't want that, and the Americans very plainly don't want that. The other thing about defanging Iran to keep in mind is that Iran is a major sponsor of terrorist groups such as Hamas, such as Hezbollah, as well as the Houthis. And getting rid of these militias or these terrorist groups, or in the case of Hezbollah, frankly, standing armies, would probably go a long way to helping stabilize countries like Lebanon, remove a major irritant for the Saudis in Yemen, as well as reduce a major threat that the Israelis have identified. So there is a filter of mutual interest of this happening. So there's multiple drivers with any event like this, and of course you can put other filters over this. You can put the Trump as a madman filter. You can put the Trump as a 4D chess player filter. Won't get into any of those. However, just as important to remember that these two filters are particularly important in understanding what is going on and why it's happening. Any value judgment, I of course, leave up to you. And again, leaving off this segment, just if you want to discuss this further or you have any questions on this, please reach out and give me a call. Here to help. Now let's touch on some of your frequently asked questions here. Now, I think that there were a lot of questions. However, a lot of the questions we received over the course of the last few weeks have really boiled down to, I believe, one key question or one key concern. And that key question is, we've had a lot of things happen. Why hasn't the market gone down more? Because as we sit here on March 25th, indexes are down 2, 5, 7, maybe 8% year to date. Now, given the number of headlines and given the level of fear that we've seen in the market, one would have think that the markets are down 20%. So why have things held up? Why has the market been so resilient in the face of so many threats? And frankly, those threats are not just the Iran conflict, but prior to this, there was a lot that happened too. There's the fact that we're going to see a new chairman of the Federal Reserve. That was raising worries. There's been concerns around the private credit market. There's been concerns about AI disruption of certain sectors. And there's been concerns around trade, tariffs, and even Greenland. So there was a lot of concerns out there, and I think we have to look at the fact is that yes, there are a lot of concerns, but one of the reasons why the market hasn't gone down is that there's an enormous number of positives. And the one that I really like to focus in on here in these comments is the fact is that despite this conflict, we've seen earnings estimates rise for fiscal 2026 or for the next 12 months. So it's important to remember that there is a lot of positive drivers going on, one of which is that earnings are going up. So yes, uncertainty does bring markets down. However, earnings and future earnings growth is also a very powerful force, because ultimately in the long term, it's important to remember that earnings growth drives stock price. Higher earnings always equals, in the long term, higher stock prices. So it's important to keep that in mind, and that's a key positive. We are seeing in U.S. GDP data as well, certain indications that outside of the government sector that their private sector economy is picking up. The very important ISM manufacturing index, which tracks the portion of the U.S. economy that is tied to manufacturing and construction and such, is back into expansion territory after contracting for 3 years. And so there's a lot of signals like this that are very, very positive. So these counterweights are important to keep in mind. And I think as we look at this, as we look forward here, it's important to remember that markets that don't, or an asset or markets that don't go down in the face of an onslaught of bad news probably are not negatively inclined. Just like if something doesn't go up in the face of good news, it's probably not positively inclined. So we want to make sure that we always keep that foremost, is that that there is a wall of worry, and that can metastasize into something just disastrous. However, almost always things are resolved to the positive and markets continue their upward move. And I believe that in the situation we're in, especially if we do see the continued rise of forward earnings estimates, we've seen a number of very powerful quantitative patterns that emerged earlier this year that do portend to positive returns in this year, that we have to stay optimistic because that's what the data is telling us to do. Now, we can also take a look here at what really is our strategy going forward. I think that was another major question that we got. And I think the key thing here is to remember that we want to be adhering to the old Warren Buffett rule, which is you want to be greedy when others are fearful and fearful when others are greedy. We've now reached a point, as I alluded earlier in this video, that fear is high enough that it is now correlating with very, very strong forward-looking returns. Again, if we go back to the slide we shared with from Ned Davis, we see that from this point of their proprietary fear index, this fear reading leads to returns in the 20 to 24% range 12 months out. That's very enticing. And that is something important to keep in mind, is that once you get through events like this, markets can rally very, very quickly. Just remember, last year in April, markets were down 20% year to date before they finished up substantially. So as we go forward, we always want to make sure that we are putting money to work when there's fear, and we always want to make sure that we are raising a bit of cash when we have greed. And this is why preparation is so more important than prediction. Right now we're in a time where fear is high and future returns are starting to look good. So we have in fact started to buy. Just like in January, when fear was very low and future returns on that basis looked poor, we actually made sure that we had cash in the portfolio to be prepared for when the time that greed turns to fear. So that is, I think, one of the core things that we are doing here. The other core thing we are doing, of course, is looking for value and looking for opportunities in the volatility. In many cases, investors have fled into consumer staples names like Walmart or Colgate or Coca-Cola, and we find that at a group, those stocks now trading at a much higher premium, at a much higher earnings premium than technology, which has a much higher earnings growth rate. So it's important to remember that there is an opportunity there, and there's also an opportunity in taking profits from our positions in energy and recycling them into parts of the market that have suffered. Right? We want to be selling high and buying low. Now, we're not market timers, we're not perfect, but we know that we can do this incrementally, and we know that we can do things in a very steady, controlled way to make sure that we are acting, again, in alignment with the injunction that we want to be greedy when others are fearful and fearful when others are greedy. So if you have any questions on this or anything else you see in this video, please pick up the phone, give me a call, give any team member a call. We're here to help and happy to discuss this or anything else that's important to you in your financial life. Thank you very much, and we appreciate your trust and confidence.